Hi, everyone, and welcome to today's investment recommendation for our Store of Value series. It's going to be an enhanced growth strategy, and later on in the webinar, I will be talking a little bit more in terms of how these enhanced growth strategies work. We're going to be focusing on gold and silver, physical ETFs. So basically, we're going to go through a bit of history. Taking you back to the 1970s, 1980s oil shock, what led up to those, and how it affected different asset prices. So to give us a little bit of background and context in terms of what is happening, and also, we'll do a little bit of a recap on the US debt situation and what it all means for these physical assets, and I think what is the best way to capture these opportunities. So before we go on, just to preface this, it's all general advice. We don't take into consideration your personal situation. And past performance is not a good predictor of future performance. So moving on to the webinar, just to recap a little bit what's going on in the geopolitical situation at the moment. I'm sure, as you may all be aware, basically, US and Israel did launch a coordinated strike on the 28th of February in Iran. It wasn't a crazy surprise, but it was a little bit of shock in terms of what there was no objective aside from regime change that they had planned out. So basically, Iran has reacted by sending rockets into other Arab states such as the UAE, Saudi Arabia, Qatar, and they've closed off the Straits of Hormuz. So, I think for people who are not too familiar with that geography, the Strait of Hormuz is a very narrow strip across the Persian Gulf. It's only about 33% wide. It carries about 23% of the world's oil supply through that channel, and also a lot of important fertilizers. So at the moment, in the current situation, basically what we're seeing is that Iran is using deep sea mines, rowboats, as well as other drones to attack the strait. And it's quite asymmetrical in the sense that, in order to get a conventional navy to escort tankers through, it's incredibly difficult and high cost to do so. And that's really why it's been such a big deal, because there's no real good ways to deal with this effectively because of the asymmetry. Now, in terms of commodity prices, naturally the first thing to react would be the crude oil price. On the 9th of March, basically we saw crude oil spike up to $120 and then falling back to about $100 and is sitting at about $95 at the moment. However, the situation at the moment is that basically there's no real good date on when this war will end. So, there's a bit of uncertainty on the market, and basically the longer that we're staying in this conflict for, the bigger the oil shock. So, I kind of want to dig a little bit and look back in history in terms of the situation where this something similar has happened. And it's quite often in history that, you do see very similar events happening. So, the old cliche, basically, that history rhymes. We did see this occur in the 1970s to 80s, and a very very similar pattern. I'm not saying that it is completely predictive of the future, but we can take a lot of lessons out of this to draw inspiration on how we actually go about investing. So, just to give you a bit of a rundown, basically in the early 1970s, there was a high bout of inflation due to the Yom Kippur War, where the Arab states launched an attack on Israel, and basically there was a lot of geopolitical instability, not so much unlike today. Basically, there was a very about a 3-month war. But the oil shock actually lasted for a bit longer. But, looking at the oil price, it's very interesting because gold started at about $95, went to about $185. So it went up about another 100%, right? And then later on in the 1970s, so about 1979, that disruption was caused by the Iraq and Iran war. So basically when they went to war, again, there was a lot of instability in the Middle East, and that caused oil to spike. And we can kind of go through history and see some of the other moves that cause gold and silver to really, go on a bit of a upward trend, and in some cases actually quite a substantial move to the upside. Now, you know, it's interesting seeing in this event, basically after the war began in Iran this time in 2026, we actually saw gold relatively stable around $5,000. And it's interesting because, intuitively you would think that because of the inflation, because of geopolitical risk, that precious metals would take an immediate move. But this hasn't been the case. And if you look back in history, this is pretty similar in all patterns, right? So oil prices naturally is the fastest reacting commodity and asset to these Middle East disruptions. But it's actually the after effects of this that causes the main run in all other hard assets. So inflation is the key word. And I think inflation is what everybody isn't focused on at the moment. There's some talks about it, and I think obviously, the RBA and the government understand that there will be continuing inflation. But the question is basically how much inflation, how long will it go for, right? So as we can see, typically these cycles run for around a little bit over a year to a year and a half. That if it's short, then basically obviously the upcycle for these commodities is not as extreme. Whereas if these conflicts are prolonged, we do see extended run for the hard asset classes, especially gold and silver. So in that thesis, looking back on history, we did some back testing, and basically gold sitting at about $5,000. We think it actually can go up to about $7,000 to $9,000, and the silver target, similarly, we even saw earlier this year silver went to $110. I think a fair range, if it goes on another up move, would be about $150 to $220. And that's within the next year. So the question mark is really how long will this conflict extend? In our house view, we think there's not really an easy off-ramp for Trump at the moment because he's still going for pretty maximalist goals of regime change, and it's going to be fairly difficult to achieve this. The other thing is also, it's again going back to the asymmetry. It doesn't really cost Iran that much to basically block off these trades, and they know that it causes a lot of global instability, and that's one of the tactics to bring the other nations to the table to negotiate. So it'll be interesting to see what develops. The only positive scenario would be that actually Trump backs down. So basically he declares that all objectives have been achieved and pull the US military out of the Middle East. And if there's probably still another 2-3 weeks before he's willing to do that. But if that's the case, then maybe it is a slightly shorter spike in the oil price. But, if we do come into a prolonged war in the Middle East, this is incredibly detrimental to the global economy. But the key thing is inflation. Or if the oil prices stay higher for longer, basically what we'll see is the cost of food will go up. Transportation for food will go up. And it's really going to force the hand of all the global central banks to increase rates. So what I have here is a bit of a chart in that period, exploring how all the different asset classes works, right? So, we can see clearly in the brown line, that's the inflation figures. And we see that spike after the start of the first oil shock, which is after the Yom Kippur War. And how the other asset classes reacted, right? So typically in these situations, equity markets don't do too well. However, it's not as bad as people think. The things that do well are basically gold and silver. So, and in reaction to this, the central banks have to raise rate. As we can see in the early 1970s period, gold and silver went on a bit of an up move, as well as urea. It's Urea is actually one that outperforms the most out of all these commodities, but it's very difficult to get exposure on pure urea. That's because about 30% of the world's fertilizer actually comes from the Middle East. But the second period I wanted to explore is actually the second oil shock at the end of the 1970s in the Iraq and Iran war. So we can see here that basically inflation started spiking up again. It went to about 13.5 CPI in the US. And as you can see, there's a massive ramp up in gold and silver. Now, silver's a little bit disproportionately higher, and just to give you a little bit of backstory, it was actually the Hunt brothers who cornered the market. So basically, they ended up buying a lot of silver. There wasn't enough physical delivery, and basically caused the price to spike massively. Now, and as we go towards that end of that oil shock period, we can see that the interest rate goes higher and higher. So basically, the central banks will try to do catch up to control inflation. And once it gets to an extreme peak, you'll see these commodities start to fall off and pull back a bit. The central bank is always lagging a little bit in terms of the decision because they have to operate on what is happening, and it takes a bit of time for that to work through the economy. And then after these oil shocks, the equities market will continue to recover. So the other thing to talk about is where the current state of the US debt cycle is. Now, it's at about $38 trillion. It's incredibly high, and the issue that it's caused now is basically it's very expensive for the US government to refinance, to repay the interest. The interest payments are incredibly high. Now, if we get into an inflation situation, it does really cause a massive problem. And, we already see Trump basically forcing the Fed members to say, okay, let's keep rates low and try to give an easy monetary policy. The thing that's a little bit different this time around is basically the debt is so much higher, substantially higher, and we're not too sure how much wiggle room the central bank has to control inflation. So, even if the war doesn't continue on for an extended amount of time, it's still going to cause a big problem for central banks, and there are going to be inflationary effects. So, it'll be interesting to see how it evolves, but I think it is definitely difficult for the Federal Reserve in the US to actually control if the inflation was to break out. So this comes to more our investment thesis, and I will preface this as well to say that this is a complex product. You have to know what you're doing. You have to be an experienced investor. There is risk involved in this trade, but we think that basically this will really give us a very good ability to capture what we're targeting in the market. So. What we've constructed is an enhanced growth basket, and what this means is basically there is a bit of leverage involved. So how it works is you can borrow on a loan, and it's 100% recourse on the notional amount. So what this means is, for example, if I spend $16,000 in cash, I will borrow $100,000 on the loan. You're not liable for that $100,000. However, you can lose the cash outlay for $16,000. The product is currency hedged, so it's going to be in Aussie dollars. You can use it in your self-managed super. It's available for both retail and wholesale investors. However, for retail, you will have to go through a target market determination. We've got to make sure that you understand what risks there are, and you can lose 100% of the capital that you put in. So that $16,000 that you put in, there is a chance of loss. Now, there's no margin calls, so the maximum loss is whatever you put in for the cash outlay, but you are not liable for that $100,000 of that loan. The other benefit to this is also that there is a tax ATO product ruling, and what it says is basically that we borrowed on the loan, and we can deduct the prepaid interest. So it works very similarly to negative gearing in comparing to property. In Australia, you can deduct your prepaid interest against your taxable income. So in certain situations, obviously dependent on your personal circumstance, you can claim some of it back when it comes to tax return, that initial outlay. In the basket, there's going to be two underlying ETFs. It's going to be the GLD and SLV, so gold and silver. And the price is going to be marked to the worst. So let's just say, for example, let's walk through the scenarios. If gold and silver goes up let's just say, for example, you have two. Gold goes up 60%, silver goes up 80%. It will take the worst leg of the pair. So gold at 60% will be the worst pair. But what it means is that if it goes up 60%, you will get $60,000 of profit back. So you've made about 300% return on investment. Now, if it's at 11%, what it means is at the end of the investment cycle, at the end of 16 months, you will get $11,000 back. And what that means is you've lost about 31% of your investment. And then in the worst case scenario, where if gold or silver, the worst leg, is worse than zero, so less than zero in terms of on the day when we strike the product, you will lose the $16,000 capital. In terms of the deduction, how it works is basically when it comes to tax time, depending on your tax bracket, let's say, for example, if it was 30%, you'd get 30% of $16,000 back, and that reduces the initial outlay that you have to pay. So, it's despite the risk, there is also good reward. So if this investment thesis goes well, and it, basically if gold and silver goes up 60%, you're going to have a decent amount of returns that come back. However, you must understand the risk. In terms of risk reward, it's quite good, but there are risks that you will lose the initial outlay. So in terms of the full product disclosure, if you are interested in this, we will have a full PDS, a full flyer, with the ATO ruling attached as well, so you can have a read in terms of what this all means. What do we mean by store of value? Basic store of value is an asset that preserves purchasing power over time. It protects your wealth against inflation and currency debasement. So, there's some terms that we have to go through, but in terms of the best risk to reward way to represent this view, this is a very smart way to do it. Your downside is basically capped at what you put in for the initial outlay. However, the returns are uncapped. So if you guys are interested, please message us. The advisors will be reaching out if you are, and we'll determine if you are the right fit for this product. So we'll try to get involved with the investment thesis. Thank you guys for listening.